Good morning, everybody. I'm Mike Cavanaugh with Regiment. I'm here today with Brian Kasal from FourStar Wealth Management. And this is our early July episode of Clever Conversations. Brian, thank you so much for coming on today.
Great to be here, Mike. Thank you.
Yeah, it's always fun to have another person with a mustache on the show. You know, we have to stay together.
Everyone loves the mustache. Absolutely.
Yeah. Maybe for the audience, Brian, you could give us some background on, what I'll call the entrepreneurial journey. You're an entrepreneur, you work with entrepreneurs. Would love to hear it from you, the story of, your journey.
Sure. So I started FourStar Wealth in 2014. I'd already been in the industry, Mike, for 30 years as a financial advisor. And then I became a partner at William Blair and a senior vice president, portfolio manager at Morgan Stanley. And so this was kind of the next step. Once you've run your own practice for a long time, then you may take a shot at running a firm. And some do it and don't like it, and some do it and do really well. So far we're doing quite well. But it was in kind of the next extension. But the key, though, is to watch the industry and to see how things develop, and you can see where there's opportunities to make the industry better. And that's what we're trying to do at FourStar. We're trying to create a shop that is great for advisors to serve their clients. Sounds like a simple thing, but many of the firms are not set up that way. They're set up more for the convenience of the firm, and they make profits and all, but they really don't have a platform to serve the client or the advisor that is really meaningful. They restrict everything, they control everything, and they don't really offer what clients want. And so that's what we decided to do. And we started a firm that has what we believe clients want, and we serve advisors to help them deliver that. It sounds like a simple idea, but in practice, it's almost impossible to do in the big wirehouses. So we're hopefully changing the industry.
Yeah, no, it brings up a really good point. You kind of, you as the founder, you have two clients, really, right? You've got the people that are coming to your advisors looking for wealth management advice, all the things that come along with that. But truly, your client is the advisor itself. Is that accurate?
It's Mike. It's really hard at the firm level to affect client outcomes. So we really have to work with the advisor. So in many ways, the advisor is our client, and we have to serve the advisors in hopes that they'll serve their clients better and get better outcomes for clients as well.
So what are some of the steps that go into that, serving the advisor? That's interesting.
Well, so advisors have all different skill sets. Some are smart in the planning area, some are really investment oriented, market oriented, some are not. But they serve clients in various different ways. So our role as the firm is to help train them, bring them up to speed on new products, new services, and provide an extremely broad platform of services for them to use. And so that's what we've done. At FourStar, you can do everything from bonds to Bitcoin and everything in between. We have a large alternatives platform. We do specialty work like corporate executive services with insiders at public and private companies. We do specialized insurance work as well. We'll do company benefits for our entrepreneurs, property casualty for wealthy investors who own 5 houses and 3 boats and all those kinds of important things. And then we also do work in philanthropy. Wealthy investors like to be philanthropic. The American investor is the most philanthropic investor in the world. America is the most philanthropic country in the world. And so we foster that activity. And the funny thing is, when you help people with their philanthropy, they take you more seriously as an advisor. And they even though you're giving money away, they send more money to you. So philanthropy is good for clients, it's good for society, and it's also good for advisors. So we've added all these things into our platform, Mike, that a lot of firms really don't focus on. They may do a little bit here and there, but it's part of our vibe. We have I put up a phone sleeve where you can see our logo. Maybe you can't see it. is build, live, share. And the share part is what people forget, that eventually we're going to share it. We're going to share it with everybody. We're going to leave everything when we pass. So how do we share your assets in a way that makes sense? You want to try to avoid paying the government, but you want to pass assets to your family and maybe friends, and then of course to different charities. So we focus on the share part and how to be philanthropic if they have plenty of assets today, while they're alive. Of course, we're going to share it all when we pass, right?
Yeah, I really like that. Very concise, and being in the investment world as well, that sharing component, it really, like, what rings out to me with that is long-term alignment
Mhm.
between your firm and the client. Like, you're not just like looking at them as like, hey, this is a means to revenue, but more of a means to an end that best suits the alignment of the work that we're doing for you and how we get paid, and how you share the long-term outcome with your family or your philanthropic agenda, whatever it is. Talk to me a little bit about that process, like keeping that long-term alignment so the sharing happens in 20 years. What are some of the challenges of that?
Well, I mean, it depends on what the assets are of the investor, but people will write small checks, even $5 to charities or something like that. So it's just kind of a mindset. So Americans have that mindset, and most people are somewhat philanthropic. But if you're wealthier, you can deal with structures that'll help you be more philanthropic. There's incentives to do it. The government gives you tax breaks and deductions depending on which types of charities you give to, public or private. You can just do a donor advised fund with a very small amount of money in place, like low cost basis stock or other assets into that trust. And then you can dole out the gifts whenever you want to, and take a certain tax deduction in a certain year that's advantageous to you for making that contribution. A wealthy family could create their own foundation. There's also ways you can donate money to a trust that you keep the income while you're alive, but then the charitable remainder trust will give the remainder to some charity or a series of charities. So there's grant or retained annuity trust, charitable remainder trusts. So there's all different philanthropic structures that you can work with that help pass assets to the protected people that you want to offer them to. And also the government helps because they give you incentives to do that with tax deductions and tax breaks. So it's fun work. And whenever you are talking with an investor about their philanthropy, they're usually very happy. Even if the stock market's bad, everyone's happy about their charities. So it's always a good conversation to be dealing with charitable. And like I said, it's just good karma for the world. I'm very involved in some national charities. I'm on national committees for the Boy Scouts of America. And we're rebuilding a venerable movement after the pandemic where all charities struggled. So we had our struggles as well, and we're coming back. And I work with a number of other national charities as well. So we live it at FourStar personally, and we try to help other clients live it as well.
Yeah, walking the walk, so to speak.
You got it.
I mean, that's great, because you're not, reading out of a textbook. You're on the board of a national charity like Boy Scouts of America, and that experience can help you when you're advising the clients. Hey, here's what the Boy Scouts are doing. Maybe you can take some of that experience to the client's charity, or they can share that experience with their philanthropic boards that they're on, or that they have some influence on. That's really, really interesting. It's the hands-on experience that you're walking the walk, and not just regurgitating information that you read in a textbook.
Absolutely.
And
And in our work with the Boy Scouts, we serve the youth of America, try to train them for citizenship and leadership, and we use camping and outdoor activities as a method, which is also fun. So that's a national movement. Obviously, Girl Scouts, Boy Scouts, all the youth organizations in America do great work training our America's youth to be the next leaders of America.
That's great. Back to the wealth management, the FourStar, and um, my experience working with advisors is a lot of them are entrepreneurs. They own small businesses. An independent advisor is a business owner. It's an entrepreneur. But there's different levels of entrepreneurship in the advisory space, in my opinion. I think FourStar captures the essence of the entrepreneurial spirit as well as any RIA I've met. And the question I have is, with all the changes, so FourStar started in 2014, all the changes in variances in the capital markets in the past 15 years, past 3 years, like what are the biggest challenges that you face as an independent advisor running a firm, building it by adding and training the right entrepreneurial, cultural fits for advisors? What were the biggest challenges like in the investment world, like making investment decisions in the past, decade?
Well, naturally, all investors and advisors as well go through bear markets and managing through bear markets. And, we had one that was kind of self-imposed by our reaction to the pandemic in 2020, where we closed the economy down and we had a quarter down 32% in GDP. That's never happened before. And so the markets went down 37% in 7 weeks. How do you manage through that? Right? That was a big challenge. Then, of course, in 2022, I call the worst investing year of my career, where the stock market was down big, but not the worst in history, but close. But more importantly, the bond market was down a record number, down 12% overall, because we started with no income. The interest rates were at basically zero at the time. Now interest rates are higher and investors get more money for holding fixed income or money markets. Now you can get 5%. But back then there was no yield at all. So the bond market got really slaughtered, really. It was terrible. And so dealing with that, we do have rotation models that FourStar developed. I developed with my team at previous firms in 2001, 2002. We started doing that in 2008, 2011, 2015. When the markets got really rough, we find a way to rotate out of the market and preserve cash. So last year, when the market was down 20% on the S&P and the NASDAQ was down 30, and many of the large techs were down 40, 50, and 60%, our average investor was down primarily about single-digit returns, and it would have been better than that if the bond market hadn't been so bad. It would have been even less than that. So we try to preserve capital. So that's the key when you have really volatile markets, is trying to manage through that. And we have a system that does that. It's not a perfect system, but it's done pretty well over time. And managing people's emotions. That's always the big challenge, is no matter what you've gone through in the past, many investors forget what happened in the past. If there was a bear market 7 years ago, they kind of forgot how they got through it, and they get panicky and nervous. And so it's the investor has to communicate with the advisor to make sure that we don't make any rash, crazy moves in bear markets, which people tend to panic at the bottom and they get euphoric at the top, right? That's what creates bear markets. It's what creates bull markets, is emotion over time.
Yeah.
So.
Yeah, the communication process, the being able to communicate clearly, concisely, consistently, any bear market, bull market, the euphoria or the fear. What does FourStar Wealth, without sharing anything proprietary, like what are your methods of communication? Like anytime like a portfolio rotates, people are like, oh, change is bad. Now I have emotions, uncertainty. I'm going to call my advisor. How do you educate the client on your rotation process? How do you communicate with them that, hey, there's a rotation coming, or hey, we're not in a rotation period? That would be interesting to learn, of like that communication process, managing those emotions.
Sure. Well, we do it right up front, Mike. And when we talk to clients, when we show them the different portfolios, we talk about what the portfolio will be in normal markets, 85% of the time the markets are going up. So everyone's happy, the stocks are going up and this and that. But that 15% of the time we talk directly about what we'll do when the markets start to correct. And if it's just a mild correction, then we don't raise a lot of cash. But if it's a really bad correction, our indicators keep hitting where we'll raise a maximum level of cash in the portfolio. In two portfolios we run, it's up to 50% cash. In the other two, it's up to 100% cash under certain circumstances. So we tell folks up front that that's what we'll do, and they don't really have to worry about it. We're going to execute on that no matter what. And there are times when we execute on it, and then clients will call in and say, "Hey, are we rotating?" I said, "Yeah, we are. Where are we?" And we also try to communicate, Mike, through mediums just like this. We have a long-running podcast and video series called Today's Market Explained that's available on Apple iTunes, Stitcher, Spotify. Some folks may have seen video clips on Instagram, TikTok, LinkedIn, all over the place, where we talk about these very issues. Like, we're raising cash, we're trying to get defensive, and part of our process. Our process does change over time, though, because indicators change. Like, people tend to think that they have like a recency bias, like what's going on now has always gone on. Like back in the 2000s, they introduced commodity ETFs. You couldn't really invest in commodities in America unless you had a futures broker. But now we can invest in commodities. That helped us tremendously last year when the oil markets were really hot and the grain markets because of the Ukraine war. The grains were running. Now precious metals are running again, and Bitcoin is starting to work again. So those kinds of commodities are investments in certain markets. So we'll tell clients, whatever's working, we're going to be in, and if nothing's working, we're going to raise a lot of cash. And so they're prepared for it, Mike. They know exactly what we're doing.
Yeah, I like how you put it, like no pause in the answer. You do it all up front, like that education, trust building process of your investment thesis starts day one with the client, and then that is continued through the course of the relationship. I just got a question in the chat from Sandy. I'll read it to you here. Does FourStar focus on tax advantage products, i.e. structured munis, accelerated depreciation, opportunity zones, REITs, etc.?
Sure. We have a large, Sandy, we have a large alternatives platform that has 7 different objective categories. And one of those objectives is a tax advantage list. Opportunity zones. We also work with conservation easements. Formerly, now they're called fee simple transactions. We work with solar investments that offer tax credits, energy income, which is basically oil drilling and the income from that. You can either buy a royalty program, you can actually buy the drilling itself, you can buy the drilling company. There's a bunch of different ways to do it. So yeah, we do a lot of work in those areas. And a lot of investors obviously need some tax credits based on big capital gains. So we try to work on those capital gains with tax advantage investments. They're mostly illiquid. That's part of the give up to get tax breaks. You're probably not going to have an investment that you can sell right away. But for those who are patient, you can minimize those taxes for sure.
That's great. And it's a good segue to, I was going to start drilling down on alts. You said one of my favorite words earlier in Bitcoin. So I'm going to take us down the rabbit hole a little bit on that. What kind of sparks the interest for you in Bitcoin? Were you guys early in Bitcoin? Was it an asset class? Like, how did that come up? Was it client demand driven? And how do you navigate when a client comes to you, or when you put out to a client, hey, we're going to add Bitcoin to the rotation? Be curious, because the Bitcoin world is difficult to navigate. I mean, the traditional finance is difficult to navigate. But Bitcoin definitely has brought so many questions that it seems a lot of people just shrug it off, like, Bitcoin, it's monopoly money. Or it sounds like that's not your flag that you stuck in the ground. You've assessed it. How do you guys navigate Bitcoin, and what are you investing in?
Well, Bitcoin itself, the main Bitcoin, has been out there for quite a while. And many investors have gotten involved because it's been such a big success on the upside in certain markets. But then after like a 3-year bull run, it'll have like a full year of collapse. So it's extremely volatile. I've never seen anything more volatile in my life than Bitcoin. In 2017, we invested a small amount of Bitcoin at 1,200 per unit, and it went to 19,000 by the year end. I've never seen a trade like that in my career. And so we bought some in early 2017, and it had a big success and sold part of it. But Bitcoin is designed to be as essentially a hedge against the risk of the dollar and the risk of profligate governments issuing debt. And we've done that under the Trump administration, the Obama administration. We've increased our debt from about 8 trillion to about 32 trillion now, with a little bit more in the Biden administration. So as governments keep adding debt, you look at the Japanese government, some of the other governments around the world, people get concerned about the value of the currency, and the currency can lose value versus other currencies. So then people used to always buy gold and precious metals. So Bitcoin, we would say, is like the new gold, or it was for a while, and then Bitcoin collapsed. So gold is actually a little less volatile than Bitcoin. So these are assets that you can invest in to try to minimize the damage of currency. And now the Chinese government issued their own Bitcoin, which is kind of defeats the purpose, because you want to be outside the government and avoid the risk of the government. So that's the purpose of it. Whether Bitcoin is really achieving that or not is kind of anyone's discussion. Gold did nothing for a long time. Now gold is coming to recent highs here in the last 6 months or so. So, Bitcoin, is it an asset class? I'm not really sure that it is. There's so many other coins out there now, cryptocurrencies of some kind. There's a couple hundred of them now. So it's an opportunity for investors, but it's certainly very, very volatile. It's up 85% this year, Mike. So it's had a big move this year. But people aren't watching it, right? Because it used to be at 64,000 a unit. So now it's only at 30,000 a unit. It was like, it's an old story now. But if you bought it earlier in the year, you'd be up about 80%. So it's something that investors can do with a very small amount of their money if they're comfortable with the volatility. And I would obviously tell you to consult your advisor to talk about how all that works. Because if you're not comfortable with volatility, you should not invest in Bitcoin.
Yeah, it's definitely sit down and buckle up type of investment for sure.
Right.
Len just typed in the chat if you have any thoughts on the upcoming Bitcoin halving. If that's something you follow. Well, I think I broke up a little. Are you there? Yep, you're still there. Len wanted to know if you had thoughts on the Bitcoin halving coming up.
No, if they're going to slice it up, it's just like a stock split. They wouldn't change the value much. They would just give you 2 shares instead of 1 share, and it would fall in half. So it sounds to me like they're just doing a stock split, essentially.
Got it. Yeah, we don't have to get into the weeds on the technical sides of Bitcoin. The validation that, the currency weakness, the printing of money, and the gold's inability to hedge as it had been in the past. I mean, those are solid reasons to enter into an investment for the right reasons. Moving over just alts in general, what are you seeing out there? Where is money flowing into? Is it going into alts? Is it staying in cash? What is your sentiment? You're in the market every day at the desk, answering calls. What kind of I don't want to say predictions, but what are you seeing money movement look like, and how has that changed in the last 10 years?
Well, Mike, there is an explosion in private credit programs. So as interest rates went lower and stayed low for a long time, investors are looking for more yield, and the Fed wouldn't raise interest rates for a long time to keep the economy moving. They didn't want to choke off the growth of the economy. So there are a number of corporate programs that are out there that offer 6, 7, 8% yield, and they may offer what's considered to be like a liquidity feature where you can get out. They call it an interval feature where you can get out once a quarter or pull part of your money out once a quarter. And some, are actually based on shares where you can just trade them in an open exchange, and the yields are higher. Now, what they are is they're business risks. It's not a money market. It's not a CD. It looks like it because it's just something you put money in and you get interest, but they're actually taking that money and investing it in other businesses and earning a higher return. So if you give a corporate credit company money and they give you 6, 7, or 8% return, they're going out there trying to make 15 to 20 by lending that money to companies. And part of this, Mike, has to do with the fact, excuse me, is that there are regulations on banking, and sometimes the banking industry is hard to get loans from. Sometimes they say the only people who can get a loan are those that don't need it. So as it's harder and harder to get a loan from a bank or a savings and loan, essentially the corporate credit industry has grown. But we have to be careful now that we're going into recession to make sure we're with the right corporate credit companies, because the credits do default in tough times. So you want to make sure that you're well diversified even in that corporate credit world. So that's one big area of alternatives. The other area is just real estate in general. Since we went through a 7-year bear market between 2007 and 5 and 2012 in the real estate market, there were very few homes built because there was such an explosion in home building, and they overdid it. And we had a terrible, terrible bear market in the real estate market. So there's still about 5 million units in America short compared to where we were back in the early 2000s, plus population growth. So there's a building boom on right now. So a lot of investors are investing into multifamily, into home building. Corporations are buying and building homes and renting them out in places like Arizona and Texas. So there's a building boom on America right now in the I would call it the free states, where they have lower taxes and a better economic outlook for the state. The traditional northern states like California, Illinois, New York are high tax, low incentive states. So people are moving to more tax favorable states, economic favorable states like Florida, Texas, Arizona, Nevada. And so many people are investing in those types of programs as well. And then there's every form of real estate you can imagine that's now been set up in partnerships, from commercial real estate to mortgages to multifamily to home building to just home building and owning and renting. There's all these different partnerships you can invest in. And if you're willing to put up with a little bit of illiquidity, Mike, you can shoot for a higher return in the teens. If the stock market is averaged a 10% return over time, the real estate markets, if you use the right leverage, for example, in a partnership, you can shoot for a 15 to 20% return using leverage in real estate. And so that's what the partnerships endeavor to do. So you can get a better return if you're patient. So that's why people might invest in alternatives. The negative, of course, to that is that there's no liquidity. So you can't put all your money in alternatives, but you can put maybe 15, 20, 30% at the most in alternatives, because that's the last money you'll need. And you have other monies that you can use in the short run. So.
Yeah, it's a good supplement to the portfolio from the perspective of, here's something that's performing, but it's not as liquid, not as transparent. Don't put everything in it, but it's a good counterbalance to the traditional stuff.
It really is.
Well,
yeah.
Brian, you gave us a lot of juicy nuggets and great things to think about this morning. I can't thank you enough for coming on. If anybody listens to this, I'm sure they will. When people listen to this, how do we get in touch with you to learn more about FourStar Wealth?
Sure. So you can contact us through our website, which is fourstarwealth.com, or you can just call our office directly at 312-667-1750. You can ask for me, and we'll talk about what your investing goals are, and we can set you up with an advisor who will basically walk through all these ideas, Mike, and set up a plan for you personally.
Awesome. Thank you so much, Brian. Have a great day. Thanks for spending some time with us this morning.
Thanks, Mike. Thanks, everybody.